Well, good day, all. Ira Epstein with your metal market wrap-up, and this wrap-up is for the evening of Tuesday, the 10th of October, 2023, time 6 p.m. Central Time. So, we're obviously taken back with all that's going on in the Mideast. We still have Ukraine. You don't hear too much about that right now because this has taken the headline. And unfortunately, I think this is going to go on quite a while. You don't amass that many soldiers. If you use them, how long is that going to take? So I think we just have to understand this is something we're going to have to deal with. It's unfortunate. It's terrible, actually. And that's what we're going to have to do. The news waves will be taken back with it. You'll be watching that. But we're traders. And at the end of the day, that's what we have to turn our attention to. And that's why I have this channel, because as much as my emotions run high, and I appreciate a number of you writing it, and I agree. I'm a better chartist than I am certainly a military tactician, a politician, or any of that. So let's go back to the charts. When looking at the market, we've had a nice bounce, but that's what it is so far. Now, if you'll recall, when I did my special report on the metals, on the stock indices, I thought that we could bottom at this time frame. And so far, the market is acting like that. But when you look at the metal market, what does it have going for it? Not a lot, one way or the other. And what I mean by that, you still have a dollar that's here in the 105.5 level, and you have a euro currency in the 106 zone. It's got a headwind still, the gold, of strong interest rates. Now, there's pressure coming on the market. Tonight in my newsletter, I write how a bunch of groups, mortgage bankers, realtors, have gotten together and they formed a coalition to go to Fed Chair Powell to tell him they really don't want him to raise rates or sell the mortgage bonds that they're rolling off, blah, blah. Unfortunately, they will get the ear of the Fed chair. They won't get him to commit. He can't. He's got to be independent the way he stays away from politics, and he's got to stay independent from this. He can listen. It might influence him. It might not. That's how you go with that. On the energy market, obviously the market isn't holding in the 90s. It's in the 87 area. The differential between the Brent and the WTI, sitting here about 360. It's been there for a while. When we take a look at what's going on in the copper market, obviously you've got to turn your eye to what's going on with Evergrande and Country Garden. Are these two entities going to implode? Now, China is thinking of doing a massive amount of infrastructure again. That was in the news on Bloomberg today. They're contemplating it to get their economy's growth going so they can get closer to that 5% number. You got to read every day to see what that's going to be about. When we take a look at the gold chart, you can see how the market is staying underneath the 18-week moving average of closes. That is your line in the sand. When the market is under that number, what does it mean? It means that the resistance is this number, and then you have a bias. Bias has to form, technically speaking, by the market being above or below or some indicator you follow turning up or turning down. In some manner, you're going to develop a bias, and if you use it wisely, what happens with the bias is you look at the bias and you say, the market's going quicker this way, quicker that way, what's going on? Well, so far, as long as you're under, from my perspective, the 18-week average, I have an overall downside bias. Did we get a bounce? Of course, this is the war bounce. Everybody gets very nervous, they buy. I've circled this because there's a gap here, and markets typically fill gaps. Do they have to? No. If the market gapped up here and you had another gap, when you get two in a row and they don't get filled, they're called a breakaway and then a runaway gap. Then you can get a third called an exhaustion gap. Again, there's so much to learn, and in our futures trading kit, we have so much of this information. But so far, that's just a gap. We know the event. We know that it's about what happened in the Middle East. When I take a look at the pattern, you have a lower low, a higher high. This arrow, I'm just leaving there so you can see where the market stalled, had an outside day up, and then when it took that out, it never looked back. Outside days are so important in my outside day course. So many people go, it's just an outside day. Boy, are you wrong. In looking at this, where might we rally? Well, I can argue with you and say, okay, if it wants to continue, it gets another jolt. You can get to the 18-day moving average of closes, 1892, but that's a pretty good resistance point. The market crisscrossed and it went away before anything in the Middle East happened. Remember, we were in a free fall, as all we kept hearing is the talk every day, is the Fed going to go another quarter point? We were talking, do you recall, 10-year notes, 5%, 30-year getting up there into those high rarefied area, mortgages, 8%. You don't hear that anymore because the news has been taken back by what's going on in the Middle East. Number two, we are getting some corrections right here. Number three, you got to start focusing on CPI, PPI numbers. They're right around the corner. They're going to give us an idea of what the Fed may or may not do. But at this point, I see a market void of a trend. That's the way to describe this. Has had a bear market bounce. It has ended the pulling of the straight down move, and it's got a correction. That's how I'm reading what is going on. In terms of momentum, I can argue strongly that I think the market should. That is where I think it should go. I think price and the 18-day average get even closer than they are right now, but that doesn't mean the market is ready to pick up and become a bullish market. But I do look for that to happen. So I'll stick my neck out before you get back under this low. That's what I'm looking for to happen. When I look at the gold-silver ratio, waffling. Now, if silver gets underneath its 18-day moving average of closes, then I think you want to own silver over gold. Right now, it's still gold is the favorite. When we look at the silver market, here too, you lost the embedded reading. You're getting your rally. Normally, doesn't have to happen every time, but normally when this occurs and you lose that momentum, you get a lifting of everything, and often prices like to go to that line in the sand, as I call it, the demarcation point between do you have a bullish or a bearish bias. So that's where I'm looking. Copper did it. It rallied back now after Golden Week was over. I told you last week that when the Chinese came back, I thought we'd get a rally that could carry the market because they'll come back, place their orders, blah, blah, and we'll hear the government talk about things they should do and not do. What are they going to do? Are they going to rescue any of the private property developers? You're getting all that information. This is typical. So you got to train yourself because these events happen over and over and over. But all you did is go up to the resistance point. Now you got an outside day down. The market, is it overbought or oversold? It's still in oversold territory, so I don't know how aggressive the bears will get. I call it oversold territory because any reading, from my perspective, on slow stochastics under a 30 reading is oversold. That doesn't mean it's not bearish. It is, but it's oversold. Does one deploy new money in an oversold condition by adding new shorts? Well, the way I teach charting doesn't mean it's right, by the way. No. In the platinum, I've been looking for a bounce here to come about. Same thing. So I'm getting what I wanted with today's action finally, and now I can make the argument that before prices go under the most recent low, I can argue that you go to the 18-day average of closes. So in summary, I'm looking for the metals, ex-copper, it's already done it, to have a bit more of a rally before they go back underneath the recent lows, if they go back to those recent lows. In gold, there's a gap in the chart. Gaps normally get filled over time. In the dollar index, this is exactly what I was looking for. I mean, this is textbook what my course on enhanced Bollinger Bands is about. Here is the market, and I'll show it to you. You have your embedded reading. Both numbers are going sideways over the 80 level. They've been doing it. You get a settlement under 79. It is a sign that before prices go back over this high, just what I've been telling you on the metals, that we should get down to the 18-day average. Now, it's a combination. If the prices fell right away, it's going to be very quick and bloody. But typically it takes a little bit of time as prices fall and that average is going to creep up a little bit. It's using 18 days. It's dropping a day back there. It's adding the current value here. They typically come together. I wish I could tell you they always come together. Boy, we'd all be just phenomenally rich. Yesterday was the failure day, outside day down, which is a continuation pattern on outside days, again in my course, that we should go down before you take out that high to the closest main number. And that's the 18-day average. Took a little bit, and there I am. So the number's been hit. So my downside correction in the dollar index has completed itself. Now something else. Temporarily, you've actually got a sell signal. Wow. Lower highs, lower lows, and you closed under the 18-day average. So the market either restructures, or if it's going to continue down, Bollinger Band becomes the next possible number. Not a moving average. They're too far away from the market. You're already at the 18. It's either that, or you go back over that high at some point, or restructure and create a new look on the swing line. But that takes days. So right now, as I'm there, a possible target, take out this number, you're saying, no, I don't want to be bearish. Until that occurs, guess what? All of a sudden, I have a bearish bias in the dollar, very short term. You know, one of the things we love to give you are ideas on what you learn. Now, this week we had our futures trading course. Here's something that's in it from our good friends at Modern Trader. I don't even know if you understand what GAN is, and then let alone the squares of 9, but this is very, very much used between students that believe in GAN, Elliott Wave, all the different types of cycle traders that are out there. These are mathematics, but they're easy to understand. It's not difficult. Some of these things get so difficult, I don't even try to understand them. I give up on them. But there you are, and what it meant for the NASDAQ 100, the benefits of relative strength. Now, I don't use relative strength. I use the derivative. The first one that was out there was relative strength. But there's, I think, enhanced, better things. And I went with George Lane's slow stochastics, and then I modified that from my method, and I find it's just what I want. Now, it's not for everybody. I had one of my subscribers tell me he likes something faster than that does it. His name was Mark. I won't give you his last name. I understand. I'm not comfortable with something faster. I find too much error in it. That doesn't mean I'm right. Trading with the money flow index. Rules for bottom fishers. What most of you like to do, and I get it, and that gentleman Mark was one of them. I know it because of what he wrote me and the technique he's using. You're looking on a move up or down. Where's the exact turning point in the market? I gave up on that, got to be 20 years ago. And the reason is I don't think it can be found. I think you give up too much. You're all over. You're literally married to your screen. You can't even go to the bathroom because most people that are doing that aren't using daily bar charts. They're using 5-minute, 15-minute, those type of charts trying to catch this. I don't want to do that in my lifetime. Number two, I don't know if I can. Couple of elements. I'm very comfortable with where I'm at for the type of trading and the traders that I want to attract with me. And those are the type of traders that are looking at daily charts and or weekly charts and looking for the swing trade. That is not a day trade, the momentum trade to get to a certain point and then hope. You then move your stops or you play with your indicator of momentum, and then you're hoping that it just keeps going. And you get a number of those. We just saw one in gold, that vertical price decline. So they do happen. And then how do you optimize stops? I mean, this to me is very important. They all look this way. Take a look at that. The graphs are phenomenal. The explanations are right there. This is the benefits of that. I have my own course on, as you know, the enhanced Bollinger Bands. Optimizing stops, if you can do it, it's phenomenal, and you should spend time on it because the one thing you, me, everybody's going to be, you're going to have a trade on, and you got to know where you're wrong. Everybody has losers. The only person that doesn't is in trading. How's that for reality? IraEpstein.com, free offers. Move your cursor to the top. There'll be an icon there. Give it a click. It'll take you right into the area. And while you're there, choose the other things that you want to see. I'm Ira. Have a good day. I'll see you in the next videos and, of course, in the morning. Take care.